The strategic engine of corporate finance, mastering capital allocation in modern business ecosystems in an era where financial markets are increasingly volatile and global competition intensifies by the day. Corporate finance has evolved from a back-office function to a strategic engine that drives business growth and shareholder value creation. This discipline encompasses everything from capital budgeting decisions to risk management strategies, shaping how organizations allocate resources to maximize profitability while ensuring long-term sustainability. Modern corporations face unprecedented challenges in managing their financial resources effectively. From navigating complex regulatory environments to leveraging emerging technologies for competitive advantage, the role of corporate finance professionals has become more critical than ever before. These experts play a pivotal role in determining investment opportunities, optimizing capital structures, and implementing robust financial controls across diverse industries. Understanding the core components of corporate finance at its essence, corporate finance revolves around three fundamental pillars: investment decision-making, financing choices, and dividend policy formulation. Investment decisions involve evaluating potential projects based on expected returns relative to required rates of return, often utilizing sophisticated analytical tools such as net present value calculations and internal rate of return analyses. Financing choices require careful consideration of various funding sources, including equity issuance, debt instruments, and retained earnings. The optimal capital structure depends heavily on factors like industry characteristics, market conditions, and organizational objectives. Dividend policies determine how much profit is distributed to shareholders versus reinvested within the company for future growth initiatives. Capital budgeting involves assessing long-term investments through techniques like NPV analysis, payback period calculation, and IRR evaluation to ensure alignment with strategic goals. Cash flow management focuses on maintaining adequate liquidity levels through working capital optimization and efficient cash conversion cycles across different operational segments. Risk assessment requires identifying both systematic and unsystematic risks impacting investment performance using models like Value at Risk, VAR, and Monte Carlo simulations. Strategic decision-making frameworks in corporate finance professionals employ structured frameworks to evaluate investment opportunities systematically. One widely used approach is the net present value (NPV) method, which discounts projected future cash flows against an appropriate discount rate to assess project viability. When NPV exceeds zero, it indicates that a project is expected to generate returns above the cost of capital. Complementing NPV analysis, the internal rate of return (IRR) provides another crucial metric. It represents the discount rate at which initial investment costs equal discounted future cash inflows. While useful, IRR can sometimes produce misleading results when comparing mutually exclusive projects due to differences in scale and timing patterns. Evaluating alternative investment methods. Various alternative approaches exist alongside traditional DCF methods. Payback period analysis calculates how quickly an investment recoups its initial outlay but ignores time value of money considerations. Profitability index, PI, also known as benefit cost ratio, compares present value of benefits to initial investment costs, providing additional insight into project efficiency. Multi-criteria decision analysis offers yet another perspective by incorporating qualitative aspects alongside quantitative metrics. This approach allows executives to weigh intangible factors like environmental impact assessments or brand reputation enhancement when making final investment decisions. Optimizing capital structure through financial engineering. A well-balanced capital structure is essential for maximizing firm value while minimizing financial distress risks. This involves strategically combining debt and equity financing options according to prevailing market conditions and organizational needs. Leverage ratios serve as key indicators helping analysts gauge the proportion of borrowed funds compared to total assets. Financial engineers utilize advanced modeling techniques to determine optimal leverage levels, taking into account tax shields provided by interest deductions, bankruptcy costs associated with excessive debt loads, and agency conflicts arising from divergent interests between stakeholders. Leverage optimization models incorporate trade-off theory principles considering marginal benefits of tax advantages against increasing probability of insolvency events. Modigliani-Miller theorem demonstrates theoretical equivalence between leveraged and unleveraged firms under idealized assumptions, although real-world complexities often deviate significantly from these postulates. Dual-class share structures enable founders or controlling shareholders to maintain voting power despite diluting economic ownership through separate classes of common stock with differential rights. Managing working capital for operational efficiency. Effective working capital management ensures smooth daily operations while maintaining sufficient liquidity reserves during periods of uncertainty. Key components include inventory control systems, accounts receivable management protocols, and supplier credit terms negotiation strategies aimed at improving overall cash flow dynamics. Just-in-time inventory practices reduce holding costs by synchronizing material procurement with actual production schedules rather than relying on safety stock buffers. Similarly, dynamic pricing algorithms help optimize revenue streams by adjusting invoice terms based on customer creditworthiness profiles. Enhancing cash conversion cycles. The cash conversion cycle measures how efficiently companies convert raw materials into cash through sales transactions. Shortening this cycle improves operating liquidity by reducing days sales outstanding, DSO, days inventory outstanding, DIO, and days payable outstanding, DPO. Advanced analytics platforms enable continuous monitoring of these KPIs, facilitating timely interventions. Data-driven forecasting models predict future cash requirements with greater accuracy, allowing CFOs to proactively manage short-term obligations without compromising operational flexibility. Real-time dashboards provide visibility into working capital trends, enabling rapid adjustments to purchasing behaviors or credit-granting policies. Navigating global financial markets and currency risks. As businesses expand globally, exposure to foreign exchange fluctuations becomes inevitable. Corporate treasurers implement hedging strategies such as forward contracts, currency swaps, and natural hedging mechanisms to mitigate adverse movements in international currencies affecting profit margins. Emerging market investments introduce additional layers of complexity requiring thorough geopolitical risk assessments. Companies often establish multi-currency accounts and use electronic payment gateways to streamline cross-border transactions while complying with local regulations governing foreign direct investments. Hedging instruments include futures contracts for locking in exchange rates over specified durations. Options grants flexibility without obligation to execute trades at predetermined prices. Balance sheet hedging matches asset-liability exposures denominated in same currency to minimize translation gains/losses on consolidated financial statements. Political risk insurance provides protection against non-commercial losses stemming from expropriation, civil unrest, or changes in regulatory frameworks affecting overseas operations. Implementing robust risk management practices. Systematic risk mitigation forms a cornerstone of effective corporate finance strategy. Enterprise risk management frameworks integrate financial, operational, compliance, and reputational risks into cohesive governance structures, enhancing resilience against unforeseen disruptions. Firms invest in predictive analytics capabilities to identify early warning signals indicating potential threats ranging from supply chain vulnerabilities to cyber attacks targeting sensitive financial data repositories. Scenario analysis exercises prepare leadership teams for various contingency situations through simulated stress testing scenarios. Quantitative risk modeling techniques. Advanced statistical methodologies such as value at risk, VAR, quantify probable losses within defined confidence intervals. However, limitations persist regarding tail risk estimation, particularly during extreme market volatility episodes witnessed historically during crises like the 2008 financial downturn or recent pandemic-induced shocks. To address shortcomings in VR-based approaches, institutions incorporate conditional value at risk, CVR, measurements focusing on average loss severity beyond predefined thresholds. Stress testing procedures apply historical analogs or hypothetical shock scenarios to evaluate systemic stability under adverse conditions. Leveraging technology for enhanced financial governance, automation, and artificial intelligence revolutionized traditional corporate finance functions, transforming manual processes into intelligent workflows capable of processing vast amounts of data instantaneously. Machine learning algorithms detect fraudulent activities within transaction records far more accurately than conventional audit trails alone could achieve. Blockchain technology introduces immutable ledgers, ensuring transparency across decentralized networks, beneficial for intercompany reconciliations or secure document sharing among geographically dispersed teams handling sensitive financial information securely. Robotic process automation (RPA) automates repetitive tasks like journal entry postings, reconciliation checks, and report generation, saving thousands of labor hours annually. AI-powered forecasting tools utilize neural network architectures trained on historical datasets, predicting future financial outcomes with remarkable precision. Cybersecurity frameworks implement zero-trust security architectures, preventing unauthorized access attempts, exploiting weaknesses in legacy IT infrastructure. Preparing future leaders in corporate finance, continuous professional development remains vital given the rapidly evolving nature of modern finance landscape, shaped by technological advancements and shifting regulatory landscapes. Industry certifications such as Chartered Financial Analyst (CFA) designation equip practitioners with specialized knowledge spanning portfolio management, derivatives pricing, and macroeconomic analysis. Academic programs now emphasize experiential learning through case studies involving real-world financial dilemmas faced by Fortune 500 companies worldwide. Internship placements with multinational corporations offer hands-on experience dealing with complex M&A deals or IPO preparations under seasoned mentors guiding career progression paths. Bridging academic theory with practical application, collaborative research initiatives between universities and leading financial institutions foster innovation by applying academic theories to practical problems encountered in contemporary business settings. For instance, behavioral finance concepts influence compensation structures designed to align executive incentives with long-term shareholder interests. Professional associations host regular webinars featuring expert panels discussing cutting-edge developments in fintech solutions disrupting traditional banking services, or ESG investing trends reshaping corporate responsibility expectations among institutional investors seeking sustainable growth avenues. Conclusion: mastering corporate finance requires not only technical expertise but also strategic vision aligned with broader organizational objectives. As digital transformation accelerates adoption of new financial technologies, adaptability becomes paramount for sustained success amidst constant change. Professionals engaged in this field must remain vigilant about emerging trends influencing capital allocation decisions while continuously refining their skill sets through ongoing education and peer collaboration. By embracing innovative approaches grounded in sound financial principles, they position themselves at the forefront of driving enterprise value creation in today's dynamic economy.